In this video, I'm going to show you how to build a solid trading model from the scratch so that you can save a lot of money from buying useless signals. Let's go.
Welcome to RFT Airlines.
I'm going to start with these 7 rules that your trading model should be built around. And then after that, I'm going to create price charts to show you exactly how to apply all these rules in rebuilding and building a solid trading model that will work over time. Meaning it's going to be a step-by-step process on how to build a solid trading model. I'm going to make use of a scenario for a trade that I took on the 4th of May on the US30. Now let's get into it and see what's going on. Number 1, I've got instruments to trade. Instruments to trade. You've got to pick instruments that you're going to specialize on, that you are going to stick with, that you're going to make sure that you're going to study them by heart. You know everything about them, when to trade them, when it is the bad time to trade those instruments, when you just need to keep out of those instruments and not trade them and all that. You need to have a list of those instruments, something around 6 or 7. It shouldn't be something around 10 because that will be out of order. Now, why this one is so important? It is so important to have like a list of instruments because it is rare and almost impossible to find or build a solid trading model that will work on all instruments that are available in the market. So that's why it's so important that you pick your list, that you are going to stick to them by all means. So for me personally, I trade NAS100, US30 and BTC/USD. These are instruments that I specializes in. Even though there are the extended instruments like the XAUUSD, EURUSD and GBP/USD that I trade, but the ones that I specializes on are these ones, these 3, right? Which is the same thing that you've got to do. It is to pick the instruments that you're going to trade. Secondly, you've got when to trade, like the timing element. This one is so important because the market moves based on time. The market starts to be decisive when it's time to move has structured. That is when you are going to see the market become decisive in terms of the movement that it distributes from there. Now, this is not based on your availability or your feelings, as if like you feel like trading around 6 or you feel like trading around 12. No, it's all about the nature of the instruments that you are trading. So that's why I said at first place, pick instruments that you are going to stick to them and understand everything about them, including the timing element, which is exactly this part comes in. You've got to know exactly when to trade those instruments, meaning you've got to pick the timing element that you are going to stick with, that you know exactly that I trade these instruments at this time. For example, for me personally, I trade these instruments as from 15:30 New York Open. I don't trade these instruments before 15:30 New York Open because it's the timing element that I discovered and found that this is when these instruments that I trade start to be active. That's when they start to be decisive in terms of the movement in that way, which is the same thing that you've got to do with your instruments that you've just discovered or that you've just picked that you're going to stick with. You've got to make sure that like you pick their timing element that you're going to trade them. On the third one, I've got the market condition. Now, this one is so important because you've got to be aware of your surroundings. Setups can fail. Some setups do fail. Sometimes they don't just fail because they fail on their own, but they fail just because you applied them in the wrong market condition. So you've got to know exactly where are you going to apply your setups from. You've got to understand the type of market condition that you want to apply your trade from, and then you've got to know the market condition that you need to avoid, that even if like a clear setup could appear from, and then you're gonna say no thanks, I'm not going to be part of that because it is against your will. It is against the type of market condition that you want. So there's different market condition out there. There is the choppy market condition, low volatile market condition, high volatile market condition, clear market condition in terms of the direction and all that. You've got to pick one, the one that you're going to stick with, the one that you want to execute from, and then the one that you want to avoid by all means. So for me personally, the type of market condition that I want to trade around is high volatile market and clear direction market. That's the type of market condition that I want to trade around, because trading around the low volatile market condition and the choppy market condition, I'm finding it difficult to trade around those market conditions because I can't see where they are going, so I can't project what's going to happen from there. So I avoid those market conditions by all means, and then start to stick with these ones that I just found from there, which is the same thing that you've got to do on your side as well. You've got to find the type of market condition that you need to avoid, and then the one that you want to trade around. Next one, I've got the market bias or the daily bias. Now, here we are talking about identifying or determining the direction of the market that you are going to take at the right time. So here it's all about the bullish and bearish. Now, you need to have like the list of things, or elements that will help you into identifying the direction of the market. My suggestion is that always have two or one way of identifying the market, the daily bias. You find someone having like 3-4 way of identifying the daily bias. Look, if your trading model has so many elements behind it, it becomes difficult to trade with and difficult to execute with the trading model. So you need to have few elements behind your trading model from there. Now here we are talking about higher time frame supply and demand, higher time frame support and resistance, higher time frame trend lines, higher time frame CRT, higher time frame candlestick patterns, and all of those things that will help you in identifying the market, the direction of the market. You've got to have a list of those, and say, no, I'm going to pick one or two, or these one or two things out of all other things that help in identifying the daily bias. Because once you try to take everything to your head, to try and implement everything in the market, it will confuse you a lot. So you need to have one or two ways of identifying the daily bias from there. So for me personally, what I use to identify the daily bias is 9 and 15 price section. Between 9 and 15 price section, what I'm looking for, I want to find if the market gave me a continuation of the reversals. So I've got to know the characteristics of a continuation of the reversal that the market always produces or give me between 9 and 15. Then from there, that's the price section that I want. That will help me in identifying the direction of the market from there at the right time, or that I'm going to take at the right time. So that's what I'm talking about. You've got to find what you, or like the elements that you're going to use to identify the daily bias from there. And it shouldn't be something complex, one or two things, and then you're done. On the next one, I've got the time frames. Now, time frame, there are so many time frames in the market. So that's why for you, it's so important to pick not more than 3 time frames. Pick 1, 2, 3, not more than 3 time frames when you want to trade in the market, because having so many elements, like more than 4 or more than 3 time frames to look at, it will confuse you a lot, because it is rare to find a scenario where like almost 4 time frames agreeing or lining up in saying one same thing. It is rare to find a scenario like that. So you will always be up against the market and confused if you are going to use like so many time frames. So it is so important to identify which time frames are going to use and how many of them. For me personally, time frame that I use are 2. 15-minute time frame and 4 hours time frame. These are 2 time frames that I just stick with. I stick to these 2 time frames in that way. But for you, depending on what type of a trader you are, then you can choose your time frames. And then always have to make sure that it's not more than 3 time frames, and it's always a smaller time frame and a bit of a higher time frame from there, depending on what type of a trader you are. On the next one, I've got the entries. Now, talking about the entries, now this is where we are all about diving into the market. You're all about diving into the market. The part that is so important right here, pick elements that you are going to use to enter into the market. Here we are talking about things like the break of structure, liquidity sweep, the candlestick patterns, the CRT as an entry. We are talking about things like the change of character and all other things that are out there that are available to you to trade or to enter into the market from there. But what is so important is that pick 1 or 2 ways of entering into the market, because once you have so many ways of entering into the market, you are dead as a trader. You ain't gonna make it in this industry. This industry is all about consistency. This industry is all about consistency. Having a lot of information, having a lot of things to implement or execute within the market, like it may sound like a flex, but in reality, it is a wrong thing to do. You just need to have one information that you are going to stick with and execute it consistently, and then you're going to be sorted from there. So for me personally, what I use to enter into the market is the 15-day New York Open candlestick. That's what I use to enter into the market for me personally. I don't use like a lot of things to enter into the market. Just one way of entering 1530 New York open candlestick right there. But there are some variations so that the market may just throw sometimes there and there. But I still am aware of all of those things right there. What I do, even though sometimes it may not always be about the 1530 New York open candlestick, because sometimes the market may not take me in into a trade with the 1530 New York open candlestick on the dot, but the following candlestick right there can take me into a trade. But the bottom line is that it has to be from New York 1530 New York open candlestick going forward and all that. The way I enter, which is the same thing that you've got to do. Pick your way of entering into the market. It should be one or two ways of entering, and then you're sorted. Don't try to apply everything you know in the market. No. Now, on the last one, this one is the most important one. This one is more important than on all other elements that I've just explained right here. What invalidates the setup? What invalidates the setup right here? So you've got to try by all means to find one or two ways of one or two things that invalidate your setup, because a setup will fail. A setup will fail at some point. So you've got to know exactly what hit you. You've got to know your nightmare. You've got to know your enemy. What type of market condition that get you to get your setup to fail the most. You know it. So you've got to try by all means to find it, so that each and every time when you are seeing it afar, you can be able to know exactly that, I know I can see you, past it. Don't try me. So that's why it's so important to always take note of or try to find what invalidates your setup. So for me, what invalidates my setup is the midnight and 9. Highs and lows that were created between midnight and 9 are the ones that are my nightmare. I know by all means that, like, if I'm going to try to take a trade from the market that didn't break out or trade out of the highs and lows that was created between the midnight and 9, I know exactly that I'm going to be in trouble if I did that. So that's the type of market condition that I know exactly that it will always invalidate my setup. It's always invalidate my setup. So the safest way to do it is to keep out. So I know a scenario that invalidate my setup from there, and then I don't participate, even if the setup could be good. So that's exactly what you should do in that case as well. You've got to know exactly the scenario that invalidates your setup. Is it? Now we're on the real price chart right here, and we've got elements of a trading model that we just built from the rules part. On this day, I was able to take a trade right here, as you can see right there on the side. Now, let's implement all these rules to show you exactly a solid trading model. Number one, we said instruments to trade. We said NAS100 to USD8, and then the instrument that we are looking at is the USD8. Number one. Number two, when we start to look for opportunities on this one, meaning like when time to trade, we said it's going to be 1530. Or S from 1530. That's 1530 there. And then we said what type of market condition do we want to trade around. We said it's a high volatile market condition with a clear direction. Then what we have right here on the chart, we have the market that is volatile and it is clear in terms of the direction right here. As you can see, you can follow everything right here. It is simple and straightforward. Then on another one, of course, the market bias or daily bias. We said we found the daily bias from the price section of the market between 9 and 15. We said we want to see a continuation or the reversal. So now let's do the market. Then on the real price chart right here, you've got 9 and 15 right there. So that means we said we are looking to find the continuation or the reversal right here. And what we found exactly was the market that opened peak one direction all the way to the downside, which gives us a continuation. So that means at the right time, we want to see the market drop at the right time. That's exactly what we are looking to find right here. That is the market direction that we just found right there. We want to sell this instrument, which is exactly what we just found right there. And then another question was the time frame. What time frame are we looking at? We said we are looking at 15-minute time frame and 4 hours time frame. Then the 15-minute time frame right here, as we just simplified it, we said the direction of the market is going to the downside right here because we saw the market open and pick one direction, easy and clear, as we can see right there. Then now on the 4 hours time frame, For the sake of the video not being long, I'm not going to get to the 4 hours time frame. But in the 4 hours time frame, we want to see candlesticks that are in line with a sell, showing us exactly that the market is going to the downside. That will confirm exactly what you just found right here on the 15-minute time frame. It's just simple as that. We want to see a candlestick being in line what you just found in the 15-minute time frame right there. Then when it comes to the entry, we said we want to see the 1530 New York open candlestick. Now there are variations that we want to see the market doing right there. But before we can get to the entry part, we need to jump to what invalidates our setup. We said it is the midnight and 9. If the market failed to break out of the highs and lows that were created between midnight and 9, it is out of order. Now let us do the marking right here to see what's happened. This is the low that was created by the market between 9 and midnight. And what we had is the market, it did broke out, meaning the market was trading out of these what? Out of these lines, as you can see. So therefore, this qualifies our things that it invalidates our setup. So it is out. This can't invalidate our setup because the market was able to get out of the highs and lows that was created between the midnight and 9. So therefore, it means this trade is good for us to take. Now, what exactly now are we looking for an entry? Let's go back right here. Now we want to see the market open, rise, and then drop all the way to the downside. And all of that have to happen on the other side of 1530. Have to happen on the other side of 1530. Now let's play and see what we have. Right, 1530 opened and drop without us being there. So we need to wait for it to rise and drop. Now this is exactly where our trade was taken from. Then our trade was supposed then to be taken right there, stop loss few pips above, and then after that we drop with the market all the way to the downside, and then we're gonna target the previous low right there, and then the risk reward ratio was 1:3.5. Let's go. Now as you can see, that's how the market did. That's what the market did. Easy as that. Easy as that. You've just created and made a solid trading model. A solid trading model.